Hi everyone, I'm Sri Devi. I'm a financial planner here in Finsherpa. We'll start with the Mutual Fund 101 webinar of today. So if you have any doubts, you can let me know, and we have a separate discussion session also. So you can ask your doubts over there as well. So this webinar is actually divided into four parts. I'll take you through all the parts each by each. So if you have any doubts at that moment, you can make a note of it and ask in the discussion session. And we'll request all participants to kindly stay on mute during the webinar and raise any question in the chat box or unmute in the later phase. Thank you. So this webinar is basically for a person who's pretty new to mutual funds and he or she wanted to know more about mutual funds and how effectively a mutual fund can act as a tool to achieve your financial freedom in planning your goals and achieving them. So moving forward, as I mentioned before, this mutual fund 101 has four parts in it. We framed it in a such a way that we'll be covering the basics of mutual fund in
Can you
part
hear
one.
it? Wait, leave and then rejoin.
uh, Hi ma'am, am I unaudible or
You're sharing your video.
yes, I'm sharing my screen. Is the screen visible, right?
Your phone speakers.
Okay. So we'll start with the basics of mutual fund. So this basic contains a lot of terminologies and a lot of glossaries you might have heard when you started your mutual fund investment journey or whenever you read the newspaper. But you might not know the exact meaning of those terminologies, and we'll believe that we'll give you the clarity in this webinar. So this part one in basics of mutual fund, the first and foremost thing is what is a mutual fund company? So basically, to put it in a very rough term, mutual fund company is actually a bridge which connects the investor with the asset classes. So there are various asset classes, as you all know. There are equities, there are bonds, there are golds. Basically, an investor can directly also invest these asset classes. If he doesn't want to invest directly and he wants someone to manage the funds on behalf of him, mutual fund company is a bridge where he can invest the fund in the mutual fund company, and the mutual fund company will invest in these asset classes on its behalf. Moving forward, how mutual fund exactly works. So basically, there are certain elements which is involved in the operation of mutual funds. The first thing is investors. So we as an investor will be investing the money in the mutual fund, and these money gets pulled up over here in the fund manager's portfolio. So basically, the fund manager, who is a part of AMC, asset management company, will be taking care of the money and he or she will be investing in a portfolio of securities. These securities can either be stocks or bonds, it can also be gold, it can be anything based on the theme of the fund which you will be selecting. And once the investment is being done, you will be getting returns from that securities which is being invested. So those returns will be paid back to the investors. So basically, a mutual fund company, LIS or fund manager or an AMC will act as a bridge connecting you as well as the portfolio of securities which you are selecting. Moving forward. So I have mentioned the term AMC when I was discussing about the portfolio fund manager, right? So what is it basically an AMC is? An AMC is an asset management company, whereas a fund manager is a part of an AMC. So for example, let's take a case of ICICI Prudential or Nippon India or HDFC. So these are all AMCs which will be taking care of your fund on behalf of yourself. So fund managers will be present, and there are two or three fund managers or even one fund manager will be dedicatedly allocated to each funds, and he or she will be taking care of your assets. An asset management company is actually a bridge wherein it will get the investors money and they will be investing on behalf of them. So the investors can be general public like you and me, or it can be company, or it can be high net worth individuals as well. So that investments can also be, as I mentioned before, can be in bonds, stocks, real estates, and other asset classes. So they act as a connecting bridge. And now, so we'll move on with the certain glossaries of mutual fund, which is actually used quite often in mutual fund industry, as well as you might have also heard a few meanings, I mean, few topics out there. The first one is asset under management, which is AUM. Asset under management is basically the total money which is managed by the mutual fund. For example, if Fund A has 10,000 crores of corpus, which has been there under the management, that complete 10,000 crores is called an asset under management of Scheme A. The second glossary which we wanted to explain is exit load. Basically, an exit load is a charge which you pay to the fund house if you wish to exit the scheme before a period. For example, once you enter a scheme, there will be a stipulated period wherein you will be have to be there for a fund. It's not like a lock-in period, but it is kind of that. But you can exit anytime you want. But if you exit before the stipulated period, you have to pay a charge of nearly 0.5% to 1% based on the scheme which you have been selected. So this exit load differs from scheme to scheme. The exit load period can be even a month if it is a debt fund, and it can be also a year if it is an equity fund. So exit load is something which you all need to consider while you invest in a scheme. But most probably, the investments which recommended for equity is actually more than 3 years, the minimum period. So I don't think exit load might be a thing which you need to wish if you are looking for a long-term investments. The third glossary which we'll be looking today
அது
is
கரெக்ட் தான். ஆனா நான் 7 மணி வரைக்கும் குடிக்க முடியாது. 7 மணி வரைக்கும் குடிக்க முடியாது. ஓகே ஓகே
Madam, can you mute that particular
ஓகே
person?
ஓகே.
can everyone stay mute before the presentation? I can do. I have to come out and do. That's why. Just give me Yeah, we'll move forward. Sorry for the disturbance. The next topic which we will be discussing, or a next glossary which we'll be discussing, is something called as an NAV, net asset value. The net asset value, to put it in a very simple way, it is a simple measure of telling you how the scheme is performing. Basically, it will be divided by the number of units from the market value of all the financial securities which the fund manager has invested. A scheme's NAV goes up and down based on the movement of the market if it is an equity scheme, and similarly based on the interest rates which is given by the debt funds based on the debt schemes which is being selected. So the scheme's NAV is very important when you take into consideration. For example, if you are going for an SIP method, the NAV of the scheme actually plays a more important role, because in a SIP, when you do month-on-month basis, so we'll have NAVs on monthly basis which is being allocated, and the number of units differs based on the NAV at point of time where you're investing. The fourth glossary which we'll be looking is asset allocation. This is the most important thing which we will be looking forward. Why asset allocation is important? Because not all investors will like to go for a 100% equity based product. There are some investors who wanted to have some kind of security. So it is always very important to check the asset allocation of a scheme before selecting the mutual funds. There are multiple equity, 100% equity based funds which is available. There are also something called as debt-based funds which is available, which completely focus on debt instruments. But in between these two, there's something called as a hybrid scheme, which has both equity as well as debt component involved. So it is always important to know the asset allocation of the scheme before selecting the scheme. Moving forward, the other three important topics is you have heard about it, and many people would have known by now, which is SIP, STP, and SWP. Most people are aware of SIP, but I'll just give a gist for people who don't know. SIP is something which you do at it is a predetermined amount, say 10,000 rupees every month. You will be investing on that month of 10th of every month. Say I'm starting an SIP now, I'll be investing 10th of January, 10,000 rupees, and then 10th of February, 10,000 rupees. This is a beautiful instrument which is actually useful for people who get regular income as a salary method or rental income, or someone who has regular income. This is also a method which we can avoid volatility, because when a share price drops, the investor will be allocated with a number of units, a more number of units, because the NAV of the particular scheme will go down. Similarly, if the share price moves up, the NAV also moves up, and the particular investor will get less number of units. In this way, the volatility is also neglected, and the fluctuating share prices doesn't make a big concern when it is for a long term. Moving forward to STP, under STP, this is actually a brilliant tool when someone wants to invest in a lump sum investment. Why? Because STP allows a person to move from one scheme to another as an SIP method. Basically, if you wanted to invest 10 lakh rupees, but you're worried whether the market is volatile and I might lose my capital if I'm investing on a lump sum method. So the best criteria to do is, or best method to do is doing it as an STP method. So what you can do is you can invest the 10 lakhs in a very debt fund, and then you can initiate an STP mode wherein 1 lakh of your money from scheme A will go to an equity fund on a weekly basis. In this way, you're actually neglecting the volatility and you're also getting the benefit of allocating more number of units by doing an SIP method. So STP is a beautiful feature when the market is little bit volatile and you are risk averse person. The third thing is actually a great instrument which is useful for your retirement planning, an SWP. SWP is basically you will be withdrawing your amount, say 50,000 every month from your accumulated corpus. This is also a brilliant tool which can be used for your tax efficiency because you will be withdrawing on a periodical basis and not as a lump sum basis. And this will also help people as a pension amount after the retirement. I've also given you a retirement plan calculator in the part 3 of this webinar. In that, sorry, part 2 of the webinar. In that, I'll also explain you how SIP and SWP, a combination works brilliantly for your retirement plan. Moving forward, types of mutual funds. So I've already mentioned 3 types of mutual funds before itself, but there are various types of mutual funds which is there. But to subcategorize, I'll be giving you a gist of how they've categorized the mutual funds. For example, based on risk, they've categorized mutual funds into 6 different categories. For example, a person with a low risk will have low risk category funds, and similarly to low to moderate, moderately high, high, and very high. Based on that, the asset allocation of the fund will be varying. For example, a very high and high risk taking person can go for a 100% equity based investments. Low to moderate to moderately high investor can go for something like hybrid fund investments. But whereas low risk investors can go for a minimum portion of hybrid and a maximum portion of debt investments. And this is how this category is being based on risk. The second thing is based on structure. So based on structure, we have 2 categories, which is open-ended funds and closed-ended funds. In the meaning is actually in the names itself. A open-ended fund is something you can enter anytime you want, you can exit anytime you want. But whereas in a closed-ended fund, if you enter, there is a lock-in period of 3 years or 5 years, which is decided by the fund manager. You cannot come out from the scheme between that lock-in period. But there are chances in between the fund manager, if he or she wishes, he will have an interval period wherein if you want to withdraw the funds, you can withdraw and come out of it. And moving forward, based on asset classes, this is a vast area we will be dealing with. Based on asset classes, there are 3 categories which is being drawn. The one is debt mutual fund, the second one is hybrid or balanced funds, and the third one is equity mutual funds. Speaking of debt mutual funds is the safest option which you can go for. It is actually similar to your FDs and savings account, but gives you more amount of returns compared to those two. So they have many subcategories that we will be dealing in an advanced mutual funds workshop, which we'll be planning ahead. But to give you a context, debt mutual fund invest in corporate bonds, government securities, and even government bonds. And this is a safest instrument ever possible. And moving forward, hybrid balanced fund is something which has both debt element as well as equity element. So based on that fund, you will be selecting whether which has 60 to 70% of equity component and 30 to 35% of debt component, and it varies from scheme to scheme. This particular fund is actually useful for a person who is very new to mutual fund. He wants to just start his investment journey and understand the mutual funds better. And a person who is not totally into risk-taking person, he can opt for an hybrid fund. The third fund, which is actually 100% equity-based fund, and this is a fund which we can like confidently recommend for a person who has 10 years to 15 years of investment horizon, where he can take the risk as well as he can attain more number of returns in the long run. And the fourth classification is based on investment objective. This is also based on five types which is being made, which is growth strategy based fund, income strategy, and there is something called as tax saving, which is like ELSS. Most people know about it. And there is retirement focus fund and there is liquid funds. And based on speciality, we have again six categories, which is index fund, which will be investing on indexes, and which is fund of fund. Fund of fund is quite what they will do is they will be investing on certain funds. So you will be investing on this FOF, and that fund manager will be investing on various funds. And we have something called as commodity funds, which will be investing gold, silver, and even crude oil sometimes. And we have asset allocation funds. Based on the asset allocation, the fund manager will select, and he or she will be investing on it. And we have exclusively retirement based funds and our children funds. So these are the types of mutual funds in a broad category. Moving forward, we will be looking into a very precisely this Venn diagram will tell you a brief about how this categories has been made on the strategy basic. On the left hand side, we have passive strategies wherein the index funds, basically the fund managers rule or the strategy will be to mimic the index. For example, we have Nifty 50 index fund, which will mimic the Nifty 50 index performance. But whereas on your right hand side, we have something called as active strategy fund. These are active funds. Basically, though they don't mimic any index fund, the fund manager will choose the equity stocks based on his or own conviction and the research which is involved. So these funds will all definitely outperform the index. But in between, there is something called a smart beta, which is actually gaining a lot of attention right now in 2 to 3 years of span. This has a great element in it. It has the index feature also in it, and it also has an active element also in it. So one great example would be Nifty 500 Momentum 50 Index Fund, whereas it will select the Nifty 500 stocks in that the Momentum 50 will be picked and they will be investing only in those 50 stocks. So, what are the benefits out of here is we have lower cost access to getting that active strategy, and we also have the benefit of outperforming the benchmark, and the diversification is also being taken care, and they have large investment capacity in the smart beta funds. And this particular funds is gaining a lot of attention nowadays. Taxation. Many people are really concerned about, okay, I've invested the amount, what is basically the taxation which is involved? There will be capital gain component which is involved. I'll give you a brief perspective. What is capital gain? When you speak of capital gain to be in a very basic term, something when you purchase something for 10 rupees and when you're selling it for 15 rupees, the 5 rupee what you're incurring is a capital gain. But there is a two component which is involved in capital gain. One is realized capital gain, other one is unrealized capital gain. So what is the difference between realized and unrealized? Is that unrealized capital gain is something you did not sell the product, you are just holding on to the product, but there is a profit of 5 rupees in the sales. But only when you sell the product, it becomes a realized gain. Similarly, only when you sell a product or only when you redeem from the funds, the capital gain is taxable. If you hold on to the fund for a longer period, the capital gains is not at all taxable. So, unrealized capital gain is that is only taxable in case of mutual funds. Taxation, here there is two elements, which is before the budget, after the budget. But I'll just explain to you after the budget. The after the budget equity oriented mutual funds, the capital gains is for short term, which is less than 1 year, is 20% of short term capital gain is taxed. And more than 1 year, it's 12.50%. And in long term capital gain, there is an exemption of 1,25,000. What I mean by exemption of 1,25,000 is you have invested 2 lakhs rupees in a mutual equity mutual funds, and after 3 years, when you are redeeming it, it has gone to 5 lakh rupees. So you have incurred of 2 lakhs rupees capital gain in the span of 3 years. In that, you can claim an exemption of 1,25,000. And in that 75,000 balance amount alone, you need to pay 12.5% capital gain. So this is how taxation works in equity oriented mutual funds. When we speak of debt mutual funds, in debt mutual funds, it is always based on your marginal tax slab rates. And there are hybrid funds, whereas after 24 months, it becomes a long term, and before 24 months, it becomes a short term. So for that also, which has more than 65% debt component, so it is also based on your marginal tax slab rates. And similarly, we have equity fund of funds, where more than 24 months, it becomes a long term. So it is subject to equity taxation, which is 12.5%. Less than 24 months, it is subject to marginal tax rates. And similarly, we have overseas fund of fund, That is also applicable on the equity fund of one component. And we have gold. That is also similarly more than 24 months, it's 12.5%. Less than 24 months, it's based on your marginal tax rates. The marginal tax rates will be based on your income, what are you filing. So now, the big question here is what's the difference between a regular plan and a direct plan? Most of the clients we encounter will definitely ask this question. So basically, to be straightforward, regular plan has a distributor like us in between you and the AMC, but the direct plan, you will be investing directly with an AMC. So that is the brief perspective. But what is the difference? What is the benefit which you will be getting with choosing the regular plan instead of a direct fund? So before that, you should be asking yourself three questions before you are investing in a direct fund. The question number one would be, can you do in-depth research yourself? If you can do the in-depth yourself, you have the capability to do it and your expertise in it, you can definitely do your research and you can do DIY your investment and you can invest it. The second thing is, are you okay losing money due to your choices? If you don't have the capability or you're not expertise in doing the research and you've led to any losing money and you're okay with it, then you can go ahead with a direct fund. The third thing is, will you be comfortable without simple tracking? The mutual fund tracking is very, very important. Review is very, very important. A scheme A can perform ultimately better right now, but down in 3 lines, 3 years, it may not perform better. So tracking and review is very important when it comes to mutual funds. So are you comfortable with simple tracking and you're okay with review, then you can obviously go for DIY investing, which is direct funds. But if you don't have that expertise and you're not okay by losing money and you don't have the time and energy to do the tracking and review, then the better option would be regular funds. So the next slide tells you what are the benefits of choosing a regular plan versus a direct plan. I'll just give you the what are the benefits of direct plan first. Definitely, there is a low expense ratio involved, a higher NAV will be there, and higher returns will be there. But it doesn't mean that returns was not possible in regular plan because both direct and regular plan will be investing in the same schemes. But here you will be having the expert advice and there is a smooth process involved. Even if there is any problem in the investing, we have a separate operations team to take care of it. And there is also regular monitoring by reviewing and regularly reallocating your asset allocation based on your risk profile as well. So that is the difference between a direct plan and a regular plan. Next, we have what is in general benefits of investing in mutual funds. We'll start from the top, which is flexible investment tenure. Basically, in mutual funds, it is not like FDs where you have lock-in period of 1 year to 3 years or 5 years. Whenever you want, you can enter a mutual fund. Whenever you want, you can exit a mutual fund. So there is a flexible investment tenure and there is no lock-in period. Only in closed-ended funds, we have a lock-in period. But in open-ended funds, you can enter anytime and exit anytime. The second point is convenient and hassle-free. Basically, nowadays, there is so much convenient in doing mutual fund that only if you invest right now and if you want to redeem the next day also, it is possible. The redemption is so easy, the investment is so easy, and it is very hassle-free. The third one is minimal paperwork. We have opened multiple NRIs accounts. We have opened multiple person who's staying in Delhi and Bangalore. No paperwork is involved because everything which we do is in online. So minimal paperwork is involved in mutual fund investments. SIP assures power of compounding. This exclusively power of compounding we'll be dealing in the fourth part of our webinar. But SIP will definitely give you the guarantee of the power of compounding effect. Manages inflation. Inflation is actually right now at 5 to 7%. So if you invest in a savings account or an FD, you can never beat inflation. But whereas if you consider at least a hybrid fund, which gives you 10% rate of return on a minimum basis, or equity-based mutual funds, which gives you 12% rate of return, it actually manages your inflation and takes care of the purchasing power as well. Taxation benefits. We have exclusively ELSS funds, which concentrates mostly on taxation benefits, safe and transparent. At any point of time, you can just log in into your app and you can check your mutual fund NAV status, your performance and everything. And it is completely safe and backed up by the rules and regulations of SEBI. Moving forward, we are going to the part 2 of our webinar. Let's talk numbers. So basically in this part, we have derived a plan and we are going to be exhibiting to you how mutual fund will be helping you in your retirement planning as well as child education planning. Let's start with retirement planning. Here we have taken a certain set of assumptions and derived a plan. So for example, if a current age of an investor is 35 and is going to be retiring at the age of 60. And life expectancy we are taking as 85. So number of years of retirement is from 60 to 85 will be his retirement age, and from 35 to 60 will be his saving period for the retirement. If he comes and tells me that, okay, monthly expenses will be 50,000 for me right now, so take the same thing for a retirement. So the monthly expenses of 50,000 will become 6 lakhs of annual expenses, which he is requiring for his retirement. But now the same 6 lakhs will not be there. Once he is going to be retiring, inflation takes a major portion, right? So the 6 lakh rupees which you saw in today's value would have become 20 lakh rupees when he is retiring. So basically, 5%, taking 5% of inflation rate has become 6 lakhs, from 6 lakhs to 20 lakhs and 31,000. And as you know, we take a certain assumptions which we when you do a financial planning. In over here, we have taken 5% as an inflation rate. Pre-retirement rate we have taken as 12%, and post-retirement rate we have taken in 7%. Why? Because we are assuming pre-retirement the person is not really need not approach this fund at all. This is something which he's going to be saving for a retirement, and he can be as aggressive as he wants. So we'll be investing in a 100% equity-based portfolio. But post-retirement, we believe that this is the fund which we'll be looking for. So that's why we'll be as conservative as we can. So we'll be investing in a hybrid or debt mutual fund. That's why we're taking 7%. So considering real rate, which is 2%, after the retirement also the inflation will take into consideration. At the real rate 2%, the corpus which he will be requiring at the time of retirement is 4 crore rupees. So there are two ways in achieving this 4 crore amount, either through an SIP mode or through a lump sum mode. If it is an SIP mode, the monthly investment which is required is 21,000 rupees. So if a particular person is planning for his retirement at age of 35 and wants to retire at 60, by having 50,000 as a monthly expense after retirement in today's value, he has to invest 21,000 as an SIP, and he can enjoy the retirement corpus completely. So the lump sum investment required, if he has some inheritance or he is one person who is doing business and invest in a lump sum, he can invest 23 lakhs 59,000 and aram se enjoy his retirement journey. So the next page will give you the SIP and SWP's deadly combination. So here you can see this is a beautiful combination where it works in accumulation phase, whereas when he is planning to save for his retirement, SIP is a brilliant tool where he can approach. So from 35 to 60, he will be investing 21,351 month on month basis. So your his early investment would be 2,56,000. After the retirement, what will happen is he will be taking an SWP on a month on month basis, but this includes inflation as well. For example, at the age of 61, he will be withdrawing 1,77,000 in today's value, which is 50,000. And similarly, 62 years, at that 62 years, he will be withdrawing 1,86,000 on a month-on-month basis. This is including inflation. That's why this figure is increasing year-on-year basis. So that's why SIP and SWP is a very deadly combination when it comes to retirement planning. I'm moving forward to children education planning. In children education planning, as you can see, we have also taken a certain assumptions over here. If you want your child's corpus of education for 1 crore rupees and the current age is the child is newly born. So if the child is newly born and the target year is 2044, we have 20 years for it. The current corpus required would be 1 crore rupees at the inflation rate of 5% of education cost, and investing in an equity mutual fund because we have 20 years time horizon, which is 12%. So if you can see, the 1 crore would have become 2 crore 65 lakhs. So to achieve that 2 crore 65 lakhs, one has to have, similarly, one will have two methods. One is monthly investment method, another one is lump sum investment method. Under monthly investment method, he will be investing 26,000 rupees to achieve the 2 crore 65 lakhs amount. Or else, if he's going to plan for a lump sum investment, he can invest 10 lakh 36,000 and enjoy 2 crore 65 lakhs when the child becomes 20 years. So he or she can plan for his child education corpus. I hope there is no doubt over here. So I'll move forward. And we have something planned for you, is part 3, which is this or that. So under part 3, we have certain clients who comes and ask me, okay, which is better, this or that? Or what is it actually, which is comparatively this or that? These questions often come to us when client speaks. One of the question is SIP versus lump sum. What is basically a difference between SIP and lump sum? So in SIP, the frequency of investment will be in a regular intervals. For example, if I'm planning for 5th of every month, every 5th I'll be making an investment, say 5,000 rupees or 10,000 rupees. But when it comes to lump sum, I'll be making only one time single payment of a lakh rupees or 10 lakh rupees. When you see volatility in SIP, the volatility is pretty low because we are not in some investing a lump sum investment. We are making that investment on a periodical regular basis. But when you speak of lump sum, there are chances of high volatility. Cost of investment, as you can see, SIP has a very lower cost because it does rupee cost averaging by investing on a regular intervals. But whereas in a lump sum, higher the cost. If you see of investment size, the SIP will be very low because most probably people will choose somewhere between 25,000 to 50,000. And there are other people also who chooses 75,000 as an SIP monthly investment. But when you say lump sum investment is usually higher. It can also be 5,000 rupees as lump sum, but it is usually higher. If you see of risk appetite, low to moderate investors, risk appetite person will choose an SIP method, whereas moderate to higher risk appetite person will choose a lump sum investment. And if you see of investment horizon, it is actually based on your goals. But to be precise with respect to these two methods, short and long term for SIP, long term as per market outlook for a lump sum investment. But apart from this, it is a method which you can choose based on your income source. For example, if I am a freelancer person, I will be getting investments or I'll be getting income at not on a very regular basis. I'll be getting once my project gets over, then lump sum investment is something which you need to consider. For example, a salaried person, his or her better investment option would be SIP because he or she will receive income on a regular month on month basis. So it is always depending on your income basis, you can select between SIP and lump sum. Another this or that question is, what is the difference between normal SIP and top up SIP? Many people will come and ask this question. Basically, actual SIP is once you have fixed the amount of 10,000 rupees, you will be investing the same amount throughout your investment journey. But if you opt for a top up, say 5% top up or 10% top up, you will be increasing the SIP amount every year. For example, if you are investing 10,000 this year and you're opting for 5% top up, you will be investing additional 5% on the next year. Or if you wish to top up 10%, you will be investing additional 10% next year. Similarly, additional 10% the second year. So, what is the benefit which is getting out of this actual top up versus normal top up SIP is in a top up SIP is quite beneficial when a person gets hike year on year basis because his income will be increasing year on basis. Similarly, his investments can also increase accordingly and he can get a huge benefit. This particular table will give you a brief outlook of how top up SIP helps you out. As you can see, a 5% yearly enhancement of an SIP will give you nearly 20% enhanced growth. And 10% will give you 47% enhanced growth and 15% will give you, just a minute, 80% enhanced growth. As you can see, the normal investment cost over here is also increasing as the growth amount is also increasing. So if you are a person who's actually planning to get hikes every year, you have that kind of investment source, what you can do is you can plan for a top-up SIP on a year-on-year basis. It can be as low as 5%, but still it will give you a greater benefit and you can also achieve your goals even before the target year. Moving forward, we have liquid funds versus savings account. This is something which many people also ask. So savings account will give you 3.5% to maximum of 4%. So that is something which we all know. And it is also given on a quarterly basis. So what is basically liquid fund is? Liquid fund, as I mentioned before, it is a form of debt fund which will give you somewhere between 7% to 7.5%. So here is a comparison which gives you on a year, if you're invested 1 lakh in a savings account and 1 lakh in a liquid fund, and you're redeeming that amount after a year. And as you can see, the redeemed amount over here is 1,04,000, which is 4,000 is your interest as per 4% interest rate. Whereas over here, 7,392 is your total interest rate because it gives you 7.37% interest rate. But both are subject to taxation, right? So when you speak of taxation, savings bank account has an exemption of that. So that's why it is not taxable and it gives you 4,000 post-tax interest rates because it has a benefit of less than 10,000, you're exempted from that tax benefit. And similarly, if you see liquid, as I mentioned before, it is subject to taxation on your tax slab rates. So here I'm assuming the particular person falls under 30% tax slab rates. If that's the scenario, he'll be paying 2218 as a tax slab rate. But even after paying taxes, he will end up with 5174. Here, the investment amount is 1 lakh rupees. But imagine if you're investing 10 lakhs rupees. There are many people who keep 10 lakh rupees in a savings account. I wonder why. But still, if a particular person invests 10 lakh rupees, imagine the difference over year. Even with 1 lakh rupees, you are getting a benefit of 1000 rupees every year by investing in liquid fund compared to a savings account. This is also as liquidable possible because once you put redemption today, you will be getting it tomorrow if it is a business day. So liquidity issue is also sorted, and similarly, you will also get a higher interest rate when it compares to savings account. Moving forward, we have debt fund versus fixed deposits. This is no wonder a big question. Actually, what will happen here is many people will have 10 lakhs, 20 lakhs in fixed deposits. And they will ask us, okay, what is the difference between a debt fund and fixed deposits? To simply put, both are debt instruments. That is not at all a problem. But whereas in fixed deposits, we have something called as a lock-in period, wherein if you enter a fixed deposit in 3 years down in the line, and if you want to take that amount in case of any emergency or your targets or something like that, before 3 years period, you have to pay penal charges as well. But whereas in debt funds, you need not pay any penalty charges. There is nothing like that. You can enter anytime you want. You can exit anytime you want. That is one benefit between debt fund and a fixed deposit. There is another important benefit when it comes to debt fund and fixed deposits. In fixed deposits, even though you choose to get your interest amount reinvested in the fixed deposits, you're not getting the interest amount, you are asking them to reinvest also. Even then, you will have to pay the taxes on a year on year basis. That is a major disadvantage when it comes to fixed deposits. Even when you opt for interest payout option, even when you opt for interest reinvestment option, you will be paying that taxation on the interest amount which is required. Whereas in debt funds, only when you redeem the funds, you will be subject to the taxation which is involved. Because we've already seen only realized capital gain is taxable over here. We'll speak in numbers over here. The same thing which we discussed before. So I've taken 20 lakhs as an example in this case. The invested amount is fixed deposit in 20 lakhs. Similarly, they're investing in a dynamic debt. It's a beautiful product in the debt section, which has 20 lakhs on investment amount. While redeeming after a year, you are getting 21 lakhs 42,000 in case of FD. But over here, you're getting 21 lakh 95,000 because it's given you 9.75 percentage return. So if you can see, the interest amount is 1 lakh 42,000 in FD and 1 lakh 95,000 in the dynamic debt fund. But there is taxation involved. And in FD, both taxation is involved in FD as well as dynamic debt. So over here, you can see the capital gains, which is here is 42,000, and the capital gains tax over here is 58,647. So after the reduction, you can see the fixed deposits, you will be getting 99,000 as the amount, and post-tax interest, your profit amount would be 1,36,000. So similarly, there is a benefit of choosing debt fund over the fixed deposits fund, even after post-tax interest amount. So moving forward, this is also a predominantly many people's doubt. What is the difference between PPF as well as ELS? We all know EPF because every people in a salary person will be investing in EPF. But there are people out there who will be investing separately in PPF just because you get that ATC tax benefits. Similarly, in ELSS also we'll be getting the ATC tax benefit, not a problem. But what is the difference between them? As you can see, in this example, we have taken that you are investing 8 lakh rupees in 2009. Okay. And the current value of a scheme, which is there in ELSS, has given you 30 lakhs of amount in 2009 to 2024. But in PPF, the current value is 15 lakhs. Why? Because PPF gives you on a maximum of 8% as an interest rate, whereas ELSS has tremendously performed better because it has a lock-in period of 3 years. So it has given nearly 16% as a scheme return. You can also see through the graphs that from 2009, ELS has performed tremendously better over here. Both of them has the same tax benefits, which is ATC reduction. And when we see of this lock-in period also, ELS has 3 years lock-in period, but whereas PPF, you also have to get it out of it only after redeeming it. So compared to PPF, ELS is a beautiful option because it is market-led and also gives you greater returns. Moving forward, we'll be going to the part 4, the final part in the webinar, which is golden rules of investing. Now you know what is a mutual fund, what are the different types of mutual funds and stuff like that. So, what are the rules which we can follow while investing? That is also something which is very important. So, moving forward with the rules, we have power of compounding rule, which I mentioned before. So, what is power of compounding rule is that you are investing 30,000 every month in a 12% rate of return. So, the first 8 years, to get 50 lakhs, it will take first 8 years because it is a very painfully long period. So that is how power of compounding initially works. But that 50 lakhs to become a crore rupees, it will take only 4 years to become. But that 1 crore to become 1.5 crores, which is 50 lakhs increase in value, will take only 3 years to become. So this is what we call as 8-4-3 rule, wherein the first initial 8 years will be very lengthy. Next, it will only take 4 years to again take that 50 lakhs, and it will only take 3 years to again take 50 lakhs. But whereas, as you can see, in the 20th year, it is almost 50 lakhs every year because you have compounded that, you have gained that benefit. Over here, there's also a beautiful number which tells you in the eighth year, the investment value which you have invested is 59% and the return component is 41%. But whereas over here in the end of 24 years, your investment value is only 6% of the corpus, and the 94% what you gain out of the corpus is your return component only. And moving forward, there is one more rule which also tells you how this beautifully works. The first thing is 15, 15, 15. Example, if you invested 15,000 every year on a 15% rate of instrument for 5 years, okay? These are real-time examples. So the invested value is 9 lakhs and you will end up with 16 lakhs to the maximum. So you will get 13 lakhs to 16 lakhs at the end of 5 years. If you invest 15,000 in the span of 10 years at a 15% rate of return, you have invested 18 lakhs and you will end up with 45 lakhs. So somewhere between 40 to 45 lakhs you will be getting at the end of 10 years. But whereas here the magic happens. When you invest 15,000 at a 15% rate of return at 15 years, you have invested 27 lakhs and you will end up with a crore rupees. So this is what we call as 15, 15, 15 rule, where you will end up with a crore rupee. But if you invest the same thing for 30 years, you will end up with 10 crore rupees. So here, if you can see, the rule number one is consistency. You have to stay invested. You have to be consistent over investment. It can be as low as 1,000 rupees. It can be as low as even 500 rupees. But the power of compounding rules kicks in only when you stay invested throughout the period. It is not when you redeem it, when you crunch the portfolio, when you churn the portfolio and do multiple investments a thing. You have to stay invested. You need not redeem unless until it is an emergency. So the main rule over here is rule number one is consistency. The second rule over here is, so for that, we'll start with an example. So we have taken real-time example of investing rupees 5 lakhs from 2008 to 2024, where you can see a person has invested in 5 lakhs in 2008. Market crashed nearly by 60% because of Great Depression, and his amount gone down by 2,72,000. He did not redeem the money. And then market once again raised. He's got this profit of 6 lakhs 45,000 back then. And it was also increased by 10 lakh 54,000. He did not redeem the money. And it increased and COVID once again from 14 lakhs 55,000, it dropped completely by 10 lakh 7,000. It is actually nearing only doubled in the span of 12 years. He did not redeem the money. And once again, it shoot up like anything and went back to 20 lakh 67,000. And when you can see the only 5 lakhs which you have invested has become 34 lakh 73,000 at the end of 2024. As you can see, even when it is downscaled, he did not invest, I did not redeem the money. That's why he could enjoy this thing. He did not panic at the time of Great Depression, or he did not even panic at the time of COVID. So the rule number two is having patience. Patience is very important when it comes to investments. So you will have to be consistent when you're planning for an SIP, and you also have to be patient when you're planning for both lump sum and SIP. Even though the market is falling down, you have to remember that you're planning for a long term and the short term volatility will not concern you. The third most important rule is, so from this table, we'll first explain the table and then we'll move on to the rule. So if you want to achieve 5 crore rupees and your target here is 60 and your assumed rate of return, you're investing a 12% rate of return instrument. So for that, the monthly investment which you are planning, if you're starting at the age of 50, you need 2,17,000 to achieve the 5 crore corpus. If you're starting a little bit early, which is 40, then you need only 50,000 to achieve the 5 crore corpus. But if you're starting even more early, which is at the age of 35, you need only 26,000 rupees. But you've planned way ahead and you're starting at the age of 30, you need only 14,000 rupees. But if you're starting once you get your first paycheck, which is at the age of 25, you need only 7,775. So the rule here is, just a minute. The rule here is start early as possible. So most probably we will be recommending once you get a paycheck, start investing at least a minimum amount of 500 to 1,000 rupees. Or after getting gifts to your family and yourself. Nothing against it, but still start early with your investments because earlier you start, the amount which you will be requiring to achieve a corpus is also less, and you will also enjoy the benefit of power of compounding when you do that. The fourth most important rule is risk profile. The risk profile thing I've already mentioned. So it is very, very important to know your risk profile before investing it. So understand your risk profile, meaning that you have to understand, okay, if it is a long term, I'm ready to take risk and I will be going for 100% equity based portfolio. If your target year is only 2 years down the lane, don't go for risky investments, go for a very safe investment. So you can plan your risk profile as well as your investments based on your target year. If you are investing simply for wealth creation, then you have to understand your risk profile, whether I'm capable to take risk and I can invest in 100% equities. If not, I can move on with only 100, not 100% equity with hybrid funds, or else I can also invest in debt fund. But know your risk profile before investing. That is very much important. So let's discuss. So I'll just stop sharing. So if you have any doubts, you can let me know now. So I can see Sri Hari Sudravardan sir has raised his hand. Sir, any doubts, sir?
Good evening, everyone. I would like to know.
Sir, you're not
See,
audible.
I have the fullest.
No,
I
your voice is
know.
so feeble.
I'm talking with the mouthpiece on.
Yeah, this is now is fine. Yes.
Okay, fine. See, if at all I go for mutual fund,
Mhm.
which one is better, debt fund or index fund, or you prefer both?
No,
And
as I mentioned before the slide, it is always better to know your risk profile and what is the purpose of your investing. So there should be goals when you invest, right? So I have given you two goals, which is retirement goal as well as child education goal, right? So you have to know, okay, this is going to be my target year. There are some people who will be planning for his children education 5 years before, and there are some people who will be planning way ahead even before the children is born. So they based on your based on your goal and based on your risk profile, we'll be selecting funds and we'll be recommending it to you. So it is
that is
always perspective
that is
basis.
out of question in my case. Such I am already 59. So
Mm-hmm,
uh, retirement and
mm-hmm,
post-retirement only, and
mm-hmm,
how
mm-hmm,
long I need to wait. That
mm-hmm,
I need how long I need to wait with how much of amount. Say
mm-hmm,
uh, 5 years or 10 years with 5 lakhs, or 5 years or 10 years with 10 lakhs. What is that
mm-hmm.
you would suggest?
Okay. So, as I mentioned before, this perspective basis. So we have already got your email ID. So I'll ask Padmaja ma'am to connect with you and we'll be connecting with you in RF. So we'll work on you with an individual basis. So I can't really recommend
Okay,
funds on a
fine.
larger platform.
Yeah, before that, before I forget, or on behalf of everyone, would this video be sent through mail
Yes,
or
sir. We are
shared?
already recording it. So we'll be
That's
sharing
fine.
it to you who will join today. And
Yeah,
we'll also post it in our YouTube channel.
yeah, fine, fine. Now,
Any? Okay.
the second question is, if at all I have opted or I have invested in mutual fund,
Hmm?
in say through SIP or through lump sum, whatever it is, how do I know or how do I recognize that which one of the mutual fund is underperforming, and how do I react? Say, should I withdraw or should I wait, or how to identify that?
Mm-hmm. Over here, we have a separate tool called Morningstar for doing the research purpose. So that's why I've mentioned there is a difference between a direct fund and a regular fund.
Hmm.
Wherein I assume that you're doing directly. There are certain tools which we use here to understand whether the fund is performing better or not. And we also have various persons from fund houses come here and now and inform us based on the economic outlook and market outlook how the fund will be performing. So over here we'll be using a certain tool called Morningstar, and we'll be analyzing certain data points based on the fund's asset allocation. For equity funds, we'll be validating the fund manager's performance as well, and we'll also look on certain data points like P ratios, Sharp ratio, Trainer ratio. So we have a certain data points for each asset allocation based on the funds which we selecting. So
Do
if you're
do
doing
I
direct,
do I get to
Mhm.
know the parameter to understand which one is underperforming?
Definitely, when we are giving you recommendation, we'll be doing that analysis first and then only we'll be recommending. So as I mentioned before, it is always based on your risk profile. What is the goal which you are investing in? And the third thing is when we are recommending funds, we'll be doing the analysis first and then only we'll be recommending funds. That's
Hmm.
how we work over here.
Oh, okay. Fine.
Yes, sir.
If
We
I
have
have,
separate parameters for each fund, definitely.
yeah.
We'll definitely connect with you, sir.
Okay.
Not to worry. We've got your email ID. You
Yeah.
can also call us anytime you want through our website. So that won't be a problem.
Okay.
Yes, sir. Thank you. Any other doubts? I hope you were quite clear with what I've told. If you have any doubts, you can let me know.
Hey Sridevi, thanks for spending time explaining all these details. Had this question: is index fund always the safest bet for a long-term investment?
Yes or no, sir, basically, because for long term, because you have already mentioned for a long term, it is quite okay to take a risk and invest in a active fund as well. Because most of the times there are beautiful funds out there which gives you, which actually outperforms the index fund. So, for example, I would say the year before, which is 2024, the large cap index, which is Nifty 50, has given you only 9% rate of return. So as you can see, index is something which actually mimics how the economy is performing. But the active funds over here can outperform the benchmark definitely over a long-term period. So I would be recommending you can choose one index fund and one active fund if you want. So that's how we can couple up those things. So you can, based on the economic of our nation, you can select index fund, which is Nifty 50 or something like that, and you can pair up with another active fund so that in the long run you will also get alpha over the index and you will also have a safer bet on index fund.
Okay, sorry, I joined late. What is an active fund?
Active fund is something which doesn't mimic the index basically. For example, I would pick a large cap index fund. Okay, so they will be having a benchmark of Nifty 50 index fund, but they will be investing on the selected funds which is picked by the fund manager. So it doesn't involve all the Nifty 50 index funds. I mean Nifty 50 stocks. So the fund manager exclusively selects fund based on his conviction and the research team which is involved. That is an active fund, sir.
Thank you.
Yes, sir. Any doubts from anybody?
And sorry, one more question.
Yeah,
And
yeah, sir. Go ahead.
this is a problem I think all of us face, right? Like who's not into reading market news,
Mm, mm,
understanding the fundamentals. So there are like
mm,
thousands of mutual funds, and it's always a dilemma which one to choose.
mm, mm,
Is there a thumb rule, like a basic one or two things that we
mm,
should? I know we need to do research and do it, or
mm, mm,
um, financial planners like Finsherpa or
mm,
some other to do
mm,
it.
mm.
But if that is not an option, is there a thumb rule that we can follow by?
Mhm. If that thumb rule would be, even we'll find it better to do because we also do a lot of research involved. Because what will happen is, as you mentioned, right now we have around 40 plus AMCs and we have around more than 4,000 funds which is there in India. And it is expected to grow even more and more. Because compared to US, we have only less number of funds and less number of AMCs. But we are expecting more than that. We are expecting to grow even further. Lot number of funds, lot number of new funds which is coming in. So I would say there is no thumb rule as in, to be very honest, but it totally depends on how you want the investments to be. As I mentioned before, if a person like me who's young of age and wanted to invest in a very risky asset profile, I'll be choosing in equity funds. But if a person is approaching his retirement, say he's in 50 years old, he doesn't want to take risk, he will be going for a debt fund or a hybrid fund. So there is no exact thumb rule for selecting a fund. As on selection of the fund, also, as I mentioned before, clarifying the first doubt, it is always based on certain parameters we'll be looking into that. That parameters is also based on the fund which we'll be selecting. So we have various categories, right? For example, if you're going for equity category, we'll have certain parameters we'll look into. So I would say there is no exact thumb rule. If that is there, hard job is also become easy, right? So there's no exact thumb rule, sir.
Sure. Thank you. Thanks a lot.
Yeah, sir. Thank you so much. So I hope I've cleared all your doubts. So thank you so much for connecting today. So that too in a Saturday. So this is a YouTube QR code. If you wanted to know more about mutual funds and other investments avenues and other finance topics, you can scan this QR code and you can subscribe to our YouTube channel, watch our videos, so that you will get an even more better understanding on mutual funds. And we also conduct regular webinars and market outlooks, and fund managers meet every once in 2 months. Sorry, twice in a month. So you can also attend those webinars. And if you want us to connect personally, you can contact us anytime and you can reach out to us to get your financial plan done. Yes, sir. Srihari, sir, you
Yeah.
have raised your hand.
Madam, see, would we be getting the intimation, or if we get the notification, can we share it to the other people for attending this webinar? Is there
Yeah,
any
yeah,
scope?
yeah. Yeah, yeah, sir, you can. Anytime if you get
You
the
know,
message, you can send it
see,
out to other people.
as such, my brother attended, and my brother just influenced me.
Okay,
Likewise,
okay.
see, I wanted to share it to my friend so that he also
You
gets
can.
benefited.
You can definitely do, sir. Not at all a problem. It is
No,
open to
it's
everybody.
not only me. I'm just trying to
Hmm.
now make others people aware as how they could invest. See, the people
Hmm.
who have in my circle or in my circle are younger than me, so
Hmm.
influencing them or passing on the benefits so that they are going to be at the
Hmm.
advantage position. See, leave me alone. But
Hmm.
see, I would try to make others attend this webinar, like, so that he gets a knowledge and take
We'd
a
love to, sir. You can send it to any people you
no,
want. It is actually
but
open
I
to
need to get
everybody.
the notification.
Definitely.
Would we be getting the notification?
Every time we conduct a webinar, we'll be sending out to all our list of people which is there available. So
Yeah.
we'll be
No.
sending through emails and WhatsApp. Once you
Oh,
get that
yeah.
message, you can just simply forward it to your friends.
Okay.
Or else,
But
if you really want them to also get intimated, you can just send us your those email IDs or people who you will be recommending email IDs to us. We can also send a link to them anytime it's happening soon.
okay, but you being a fund manager or conduct only on mutual funds or equity as well, or you conduct a webinar for those
Yes,
stocks?
we are not fund managers, sir. So we are mutual fund distributors. I'm a financial planner over here to clarify that. And second thing is we conduct on not only in mutual funds, we only deal with 80 to 85% of mutual funds here. And we also
Mm-hmm.
deal PMS. We also deal with insurances. We also deal with FDs and bonds. So this is what we do. If you want to invest in stocks, it is only through PMS over here, which is called Portfolio Management Services. And the minimum ticket size of portfolio management services 50 lakhs, sir. So we don't do direct stocks, sir.
Mm-hmm. Okay. Fine.
Yes,
Thanks.
sir.
Thanks a lot.
Yes, sir. Thank you so much. So I hope I've clarified all other people doubts as well. Scan to our QR codes and you can also reach out to us through mail or through phone. I'll just stop sharing. Thank you everybody for connecting today. Have a great weekend ahead.
Thank you, Sridevi.
Thank you, sir.